to this webinar. In particular, I welcome Dr. Jean-Philippe Westhoff to the Mishra Center for Financial Markets and the Economy at IIM Ahmedabad. Just to give a brief introduction, the center undertakes practical and executable research on financial markets and the economy in the Indian context, but with reference to the global markets as a reference. And it addresses issues related to policy formulation, market structure, regulations, central bank's mandate, monetary policy, fiscal developments, real estate, market microstructure, banking, bond markets, SME financing, financial inclusion, and a variety of other topics. So we facilitate wider scope of research by faculty and by doctoral students who are working at the intersection of economics and finance. And we also engage with relevant stakeholders who influence policies and as well as those who are affected by these policies. So with this brief introduction to the Mishra Center, let me hand it over to Professor Anirban to take over for the webinar today. Over to you, Anirban.
Thank you, Professor Sanjay. So it's our pleasure to host Professor Jean-Philippe today. Just to give a brief overview of Professor Jean-Philippe. He's an associate professor at École de Lausanne and EHL, and he's also a visiting professor at the University of Freiburg. He has published in top-tier journals in the domain of finance, such as Review of Financial Studies, General Banking and Finance, General Corporate Finance, to name a few. Today, he is going to talk about his paper, which is on it's online reputation and debt capacity. So the duration of this webinar is going to be 1.5 hours. We'll be taking questions in between. So I would encourage you all to kindly put your questions through the Q&A or through the chat box, and I'll pass it on to Professor Jean-Philippe as time permits. Okay. Thank you. Over to you, Jean-Philippe.
Okay, thanks very much. So I hope you can all hear me. So welcome to my home in Switzerland, as everyone trying to get things done from all possible places these days. So it's a pleasure to present you one of my works. So I'll share my screen and start my presentation. Okay, so I believe you should be able to see my presentation. Okay, so the talk that I'm going to give you today is centered around online reputation and debt capacity. So it's a paper I've been working on now for quite some time with 3 co-authors, with François Derrien, who's at HEC Paris, Alexandre, who's in Audencia, which is also a French business school, and Arthur, who's at another French business school. So yesterday after the football match, we didn't get along very well, but otherwise we are quite friendly with each other and know each other quite well. So what are we looking at? So actually what we're looking at is something that is quite straightforward, I would say, and quite down to earth. So as you all know, well, real life and internet has become kind of quite common, and the feedback exists all around. So if you go on the web, or if you are a professor, or if you are having a shop somewhere, or if you go on holidays, everyone asks you for feedback. So if you're a professor, normally students are going to give you feedback how well you did. If you have an exam, well, you're basically telling your students how they did. You go to a shop, you can post on Yelp, on TripAdvisor, or whatever, some feedback. If you go on holidays, the same thing. So it's really all around. And what we have seen in most countries on this planet is actually that, well, this kind of revolutionized the amount of information that we have. So it used to be that, well, you had to look, if you went on holidays, in a guidebook, and you had to figure out on your own, more or less, what was okay or not. So when you would go to the restaurant or to a hotel, well, it was always kind of a surprise to know if it was going to turn out well or not. Nowadays, this is much easier. So this information that we have available is important for us as customers, I would say. So we can inform ourselves on where we want to go, how it's going to look like, if the menu is going to look okay, if the hotel is going to be okay, if the product that I want to buy is well rated or not. It's important also for employees. So nowadays you have a lot of platforms that allows you as an employee to know how good your employer is, the kind of salary you can expect, if the corporate culture is okay or not. So we have all these kind of things. And finally, what we believe, and this is where we are working on, is that this information is going to be very useful for fund providers. So this can be for banks, can be for crowdfunding, could be for venture capital, private equity. No matter what, just to have additional information from a financial perspective is very good, because the more information I have, the better decision I can take and the less risk normally I'm going to take as a fund provider. So this is a little bit the idea where we are coming from. So what we are going to look at is actually the last point, to say, well, if I have good ratings, if I have a lot of this information, does this actually help me as a company to get access to bank finance? Okay. And the idea that we have behind this is quite straightforward, to say the more information the bank has, the better decision it can take. And so basically it will be easier for the bank to accept my loan that I want to get. So this is the general idea that we have behind this paper. So what are we actually looking at more precisely? So what we are looking at is basically what you have here. So we are going to look at TripAdvisor ratings for restaurants and see if having a better TripAdvisor rating actually helps you as a restaurant to get a small business loan, okay, from a bank, for example. So why do we think this is interesting, and why do we look at restaurants? So it might seem a bit random for some of you. Well, I work at a hotel school, so for me it's a bit less random. Restaurants are a big part of hospitality. You have hundreds of thousands of restaurants across the world. It's a big business. So we believe that this is important for generally the hospitality industry. And we also believe that what we find for restaurants actually works for any kind of business. So we look at restaurants because it's of interest to us. But in the end, what we show for restaurants, you could also apply to a hardware store or to a hotel or to a university in the end, whatever you can think of. Okay. So why do we still take these restaurants? Well, we believe that the restaurants are actually quite interesting because there are really severe information asymmetry. So when you stand, and I think every one of us has been in the situation where you stand in front of a restaurant and you have to take a decision. It needs to be fast, it needs to be good, you want to eat well, you want to spend a good time. So we believe that this is kind of a good setting. So why is it also a good setting? Well, because it's a risky business. So when you look around, actually a lot of restaurants go bankrupt quite quickly. So it's not that easy to succeed as a restaurant owner. We also believe that it's interesting because most restaurants are quite small. So to be honest, I don't know how it is in India, but in Europe, most restaurants are probably, I don't know, 1 to 5 employees. So very, very small. You have a few tables and that's it. And they're short-lived. So again, what you find is that most of them, they don't survive for 50 years. So you have many restaurants, especially in larger cities, that maybe live for 1, 2, 3, 7, 8 years, and that's about it. So other reasons why I believe that restaurants is quite interesting to look at is that they provide an experience good. So an experience good is actually something that comes from economics. And what it simply means is that you must actually go and experience the good or the service to know how good it is. Okay. So if I don't go to the restaurant, I don't know the quality of the restaurant. It's the same if I drink a bottle of wine or if I taste some ice cream somewhere. Well, before I have tasted it, I don't know how good it is. Okay. And this is a bit problematic. So again, here, the more information I have, the better it is. And the more I can actually take a good decision for this good. And then the last point why we believe that restaurants are actually a good setting is that the taste and the clientele actually evolves through time. So if you live in a big city, it changes. So in Europe, Italian food is very popular. Then it kind of switched to Japanese food. Sometimes it's Indian food that is very popular. It changes kind of every year. So if you want very good information, it's not that easy to get. So this is basically why we believe that looking at restaurants is not a bad thing. So why has the internet why did the internet have an effect in this industry? Well, because actually these online reviews, so be it TripAdvisor or Yelp or whatever platform you look at, actually reveals information. And the information that it reveals, it's about current demand. So just to look at the number of reviews you get, the quality of the reviews actually tells you quite a lot about how much in demand this restaurant is at one point in time. And it kind of also tells you a little bit about the restaurant. So when you read the reviews, well, many people say how good the food is, if the atmosphere of the restaurant is good, if the service was good. And this actually triggers a little bit future demand. So as you all know, well, the higher the rating, normally the more people tend to go to these restaurants. So these online reviews actually tell you something about the status quo, so how it is today, and what the restaurant might be in the future. And this is one of our arguments, is that it affects the supply of bank credit. So your banker is not stupid. So your banker just needs to go on the internet, have a look at the reviews. And when the banker sees that you get very good reviews, well, it tells the banker that you're doing a good job, that the clients are there, that the client is satisfied with what you're going to do. And this is probably also going to drive future demand. So it kind of reassures the banker. So we are not saying that the banker only looks at the reviews and that's it. No, what we are saying is that the banker is doing its job. It's looking at the business plan, looking at your cash flows, etc. But it gives the bank additional positive information to take the decision. So another effect it had is basically on this future demand. And here, this is a bit of a problem we face in our study, in a sense, is that if the future demand is quite high, then this could also have an effect on the demand for credit. So what we mean by this is simply the fact that if you see that a lot of people love your restaurant and they are rating it well, you as a restaurant owner may have an incentive to actually increase the quality and increase maybe the size of your restaurant. So you might open a second branch, you might put more tables in your restaurant, you might invest in better kitchen tools, in better cutlery, whatever. But it might actually go from your side, a restaurant owner, to say, okay, I'm doing well, can I actually even improve on this? And this is something where we also believe that the internet and these online reviews had a lot of influence on restaurants. Okay, so what are our hypotheses and, in a sense, also our findings? So the source that we see of this link is that, well, the better the rating is going to be on TripAdvisor, the more easily you are going to get debt financing. Okay, so this is a bit the link that we are really looking at, to say, basically, the more qualitative you are, the better reputation you have online on TripAdvisor, the easier it's going to be for you to get debt. So this is the initial premise that we have. Then if we dig a little bit deeper, what we see is that this is true for total debt. So if I look at the entire debt of my restaurant, this seems to be true, but it seems to actually work especially well if I look at bank debt. Okay, where it seems to work a little bit less is for something that we call family and friends debt. So if you look at the balance sheet of a restaurant, very often what you find is really debt that comes from the bank, and then debt that basically comes from your family and your friends. Okay, so if one of my friends tomorrow would open a restaurant and I would have some money, I could say, look, I like you, I think you will do great. Here, take $10,000, I'll invest in you. And this would be this family and friends debt. And here, what we actually have as a premise and what we find is that the ratings are kind of independent of this family and friends debt. So this seems quite obvious. If it's my friend, I have other channels to tell my friend how well I'm going to do and what I'm going to do. I don't need TripAdvisor for that. So the link and the information that I can exchange with families and friends is much closer. And so the need for additional information from TripAdvisor is a bit, well, you need it a bit less. Okay, but this is what we found. So why do we find this? So this would be this mechanism idea. So actually the reason why we find this positive link is that information asymmetries are reduced. So there is more information around, everyone can take better decisions. This is the basic idea we have here. So if I look at this a bit more precisely, what does this mean? So what this means from a banker's perspective is simply that the cash flows of the restaurants are going to be more stable. And this is great news for the banker, because the banker looks at your cash flows, and if it sees that it's just going up and down all the time, this is not very good, because it means that you could easily miss an interest payment or not reimburse your debt, and the banker doesn't like this. With better ratings, it just shows that the cash flows are much more stable, so it's much easier to forecast, and the banker is a bit happy. So this is something that we find. And the second thing that we find, as you're going to see, is that cash flow risk after demand shocks is also lower. So if demand for a reason or another just stops, so I think COVID is probably the best example of this, nobody goes to restaurants anymore, those that have good ratings actually get better out of this than other restaurants. Okay, so I'm going to show you how we do this in our sample. And finally, the last thing we look at is, well, what do restaurants actually do with this additional money? So you get more debt from your banker, so you get additional funding. What do you do with this? And what we show is that actually these companies mostly reinvest this money into material. So cutlery, tables, chairs, kitchen stuff, etc., etc. Okay, so they are not kind of tunneling this out of the business. They are not using this for stupid side projects. They are really reinvesting, which is interesting from an economical point of view, because it just shows that, well, in the end, good ratings help the economy because you invest in the economy, so it triggers employment, etc., etc. Okay, good. So this is a bit the hypothesis and the findings that we have in this paper.
Philip, if I may interrupt you for a second. Yeah. So the set of companies that firms that we are looking for, the restaurants, are most of them publicly listed?
No. So what we are looking at are restaurants that are privately owned. So we have no publicly listed restaurants. So we actually, what I'm going to show you in a second, took out restaurants like McDonald's and Starbucks and stuff like this, because there is very difficult. I mean, what's the difference between one Starbucks subsidiary that you have and another one? So these large restaurants we kicked out, so we only have privately owned restaurants in the site.
And for these small restaurants that we're mentioning, you are able to get the accounting data that classifies this sort of debts?
So actually, the way we find this, the issue that we face, to be honest, is that the database just on private companies is not very deep. So we basically just take what they give us. We were in contact with the data provider as well, with the database provider, to really get a very good understanding what their categories are. So total debt, bank debt, and this family and friend debt is basically what they have in their database. So the bank debt is really debt that comes from a bank, classic bank. And the family and friend debt, actually, they call this other financial debt in the database. And when we talked to them, they said, well, we talked to them, we talked to restaurant owners as well. And what they basically told us, all of them, is that this is for the very vast majority private debt from people around you. So yeah, that's how we define it. It's not from us, it's from the database.
Yeah, thank you.
So I just continue. If there are other questions, please don't hesitate. So we are not the first one to look at this, obviously. So there is some literature on online ratings. So this is an area where it becomes more and more important to look at, more and more popular. So there are some papers that look at the effect of ratings on the demand for restaurants. So you have a very famous paper by Luca, 2016. So he is a Harvard guy. You have one by Anderson Magruder as well, who look at restaurants. And they basically check if the online ratings are good, do you get additional demand for restaurants? And what they find is yes. So basically, having a good rating helps with demand. What we also know is that online ratings are manipulated. So no matter which industry you look at, well, people are trying to, in a sense, bullshit around and try to improve their online ratings. So this we know as well. And then there is a paper that is a bit concurrent to ours by Juan, who actually looks at the probability of getting a loan and how this affects interest rates in the US. So this is the paper that is probably the closest to ours. It's a bit different because he only has data on the loans and the interest rates. We, on the other side, don't have data on the interest rates, but we have data on the use and mechanism. So we kind of have a story that is a bit complementary to what he is doing. So what we are doing basically is really explore the effect of that, how this is channeled through, and what you use and what you do with this. And then basically we also add to the very, very, very vast literature on capital structure. So there are many papers on SME financing and SME debt. So I just put one of them by Xavier Giroux, who's at Columbia right now. And then there's also a more recent paper on the effect of intangibles on debt and how this is affected. Okay, so this is basically where we work on online ratings and capital structure. So what about the data? So for the data, as I told you, we basically use TripAdvisor. So it's a choice that we made. We could also have used Yelp. We could have used other websites that exist. So the reason why we use TripAdvisor is just that in Europe, it's just the main website. Okay, so in the US, Yelp is very popular. In Europe, it's really TripAdvisor that is by far the #1. So they have 463 million visitors per month, have more than 800 million reviews. And in France and in Paris, so this is where we are actually working on, it's the clear #1. So if you look for a restaurant in France and in Switzerland, it's the same story. You go on TripAdvisor, not on Yelp. So in Paris, they have more or less 16,000 restaurants that are covered. So why Paris? Well, our first thought was that it's basically the city of gastronomy. So everyone across the world knows Paris and knows food in Paris. And actually, when you go a bit deeper, what you find is the density of restaurants in Paris is just amazing. I mean, I would say in the world, you probably only have Tokyo and maybe Kyoto that is really even better. But then we don't speak Japanese, we don't understand Japanese, so it was a bit difficult. So we believe that Paris is a very good setting for this because there are restaurants from all over the world, cuisines from all over the world. There are big restaurants, famous restaurants, small restaurants. There's everything. Okay, so this is the reason why we actually look at Paris. So what data can we get from TripAdvisor? So basically everything. So we scrap TripAdvisor. We have data on the address, on the type of cuisine, the price range. We get every single rating by each reviewer. We get all the review texts. We get basically everything that you can find on this website. Okay, so we have all of this. So what does TripAdvisor look like? So for those of you who happen to not know it, I think most people know TripAdvisor. So what is interesting to us in a sense is what you have here at the top in red. So here, for example, it's a Vietnamese restaurant, I believe, that has 8 ratings and 4.5 bubbles. And the way actually TripAdvisor does this is very straightforward. So they basically use the 8 single reviews, and then they just take a simple average of the 8 reviews, and then they round this to the nearest half bubble. So you can basically have 3.5, 4, 4.5, 5, etc. Okay, but the way to compute this, there is no fancy algorithm or anything. It's really a very, very simple average of the individual reviews. And this is going to be interesting for us later on. So what do we do then with this TripAdvisor data? Well, we try to match this with Diane. So Diane is actually kind of a subsidiary, if you want, of Bureau Van Dijk. And the interesting thing is that in France, all private companies actually need to publish some accounting data. And this is kind of the advantage that we have compared to the US studies. In the US, actually for restaurants, it's very difficult to get data on SMEs, etc. Here, we can more or less get everything we want. So they publish a balance sheet, an income statement, part of a cash flow statement. So cash flow statement is not very deep, to be honest. But we actually get all this data, and this is a huge plus. And this is also one of the reasons why we concentrate on Paris and on France, because the data is just there. Okay, so this is the reason why we have this. So we use data then between 2007 and 2017. The reason is that before 2007, TripAdvisor is virtually inexistent in Europe, so we cannot start any earlier. And the end date is basically when we started this whole project. So we get some matches. So as you can see, we lose quite a lot of restaurants. So we drop from more or less 15,000 to 5,000. And the reason is that sometimes there is not enough data in the accounting database. Sometimes there is kind of information that we cannot match. So it's quite tough, actually. And the reason is that in Diane, it's actually the legal entity that is listed. And so sometimes it's very tough to link the legal entity to the name of the restaurant. So you might have a restaurant that is called, I don't know, restaurant XY, but the legal entity behind the restaurant is called AB. And then it's kind of tough to really match both of these databases. We try our best. We do this by address, by phone number, by email, in all possible ways to get something that really works. Then we drop some restaurants, as you can guess. So those that have no ratings, we cannot work with. Those that belong to chains, so KFC, McDonald's, Starbucks, Burger King, whatever, we are not using, because again, what's the difference between a McDonald's in one place and the one 500 meters down the road? It's impossible to know. We also drop restaurants that are missing accounting information and those that we cannot. Okay, any more questions for the moment?
Yeah, I think there are a couple of questions which might be relevant at this point of time. So the first question is, shouldn't one be concerned about the selection bias in the sample, since poorly rated restaurants are likely to be absent from the consumer rating platforms?
So the yes and no. So actually TripAdvisor, so we also contacted them. So if you have somebody at, I should say Paris, it's always good because they have people everywhere. So we contacted somebody who works at TripAdvisor through them. And actually on TripAdvisor, even if your restaurant stops existing, the data is still available. So the TripAdvisor side is not the issue. There, okay, it continues to exist and that's it. The issue is right on the accounting side, if I'm honest, because there, yeah, because of the matching, we cannot have all the restaurants. So I agree there might be a selection bias in the fact that we kind of lose 70% of the sample of TripAdvisor. So what we have tried to do is look, okay, if we look at all the restaurants that are in the accounting database, are they actually, that we cannot match, are they different from those that we can match? Not really. And then we looked at the restaurants on TripAdvisor that we cannot use because of the matching compared to those that we can match. And again, it seems to work. So we are quite confident that this actually is not a huge issue. I can never kind of make sure 100%, but we believe it should be okay.
And there is a second question which basically says there is some sort of a cascading effect when you are looking at reviews. So a review is a particular restaurant is rated 5-star, not because essentially it's a good restaurant, but because other people are rating it 5-star. So do you think that that plays into, that creates some sort of problem in this analysis?
That's actually a very, very intelligent question. Yeah, so this is an issue we have. So this is something we all know. So you kind of have a, like you said, clustering or snowball effect. If you have a certain number of positive reviews, this will generate other positive reviews. I would say as such, it's not an issue. Where it becomes an issue is that the variation from one year to another becomes less and less pronounced. So once you have been, for example, on TripAdvisor for 5 or 6 years, from one year to another, your average rating is not going to drop from 4 to 3 or go from 4 to 5. So the issue that we have is more an empirical one to say that the variability of the ratings from one year to another is not very high, yes. But the clustering as such is not a big problem. Yeah, it's what it is. It's basically also what you see as a customer or as a banker, and you just need, in a sense, to live with that.
Okay. And there is one more question, but you may opt to answer for that later point of time, which is, what is the degree of correlation between the financial variables and the customer ratings? What's your observation? Are they highly correlated? They
are. We haven't run a correlation analysis, but when I look at the regressions, they are very highly correlated. So it's highly significant. Yeah. Good.
Yeah.
I continue and then I just stop in some time.
Yeah.
So our final sample basically is what you have here. So we have more or less 3,000 restaurants, a bit more than 10,000 restaurant year observations. So we are currently working on a revised version and try to increase the the number of observations. So we are working with Bureau van Dijk to actually get a better matching. So far what we have seems quite balanced in terms of location, cuisine type, price range. So as I said, we kind of cross-checked all possibilities. It really seems to match reality, even though our sample size is a bit smaller than reality. So here what you have, for example, on the right is a map of Paris. And what you see is that you have many restaurants here in the center. So the first to the 7th district, more or less, where all the tourists are. And once you go outside, much less restaurants. So it really seems to cover, our sample really seems to cover what's happening in Paris overall. Good. So let's have a look at summary statistics. So what we find, so I put in red what is kind of maybe the important stuff here. So what we find is that the median TripAdvisor rating is 4 out of 5. So here we already kind of have a bias that, well, it's kind of biased upwards. So 5 is the maximum, median is 4, and then we basically go from 1 to 5. So this is also well known in literature. People are rather positive when they actually put ratings. As such, it's not a huge issue for us, because in the end, what interests us is a bit what's happening, even if it's just 3.5 or 4.5, what's happening there. When we look at the unrounded rating, so this is basically when we ourselves do the average TripAdvisor rating, we get 3.95. So it seems to be quite okay, seems to be in line. So when TripAdvisor does the job and rounds, they get 4. When we do the job and don't round, we get 3.95, which would be rounded up to 4 if we had to. This seems okay. And then what we see is that the median number of reviews is 35 for a restaurant, but there the dispersion is quite large. So we have a lot of restaurants where you only have 1 review. So these are probably those that have some manipulation issues. And then we have 1 restaurant that has more than 2,000 reviews. And as I'm going to show you, this is quite interesting for us, because those that are up here, those are really where we are interested in. Those that have 1 review, in the end, I don't care. Like a customer, when I see 1 review, I'm like, oh, this looks really bad. Then if I look a little bit at the restaurant characteristics, so the median restaurant is 9 years old. So it goes in the direction, these are quite young businesses. Total assets in euros are 407,000. So I tried to convert this. I think this is more or less 36 million rupees. Median restaurant size. But again, here you have very small restaurants. So basically, this is just a hole in the wall. And then you have very large restaurants. So quite a dispersion here. And then when we look at the debt part, more or less 18% of assets are debt, 7% are bank debt, and this 9% other financial debt is this family and friends debt. So this is, again, also known in literature that small companies don't all use credits and debt. We have 18% of that, which is very much in line with what exists in literature on the US, for example. Okay, so let me give you a first flavor of our results. So the first results are the following. So this is, in a sense, simple OLS with year fixed effects, restaurant fixed effects. So kind of a panel regression. So what we do is quite simple. We use the debt ratio, so total debt over total assets, bank debt over total assets, and then this family and friends debt over total assets. And then we regress this on TripAdvisor ratings and the different control variables. So what we find is that basically there is a very strong, so highly significant effect. So for each extra bubble that you get on TripAdvisor, basically that goes up by 2.41% of total assets. So more or less 20,000 euros for 1 bubble increase. And then what we find when we decompose this total debt into the 2 parts is that this is very true for bank debt. So again, highly significant, coefficient is a bit lower, but this still works. On the other side, when I look at this family and friend debt, well, there the effect disappears. It's still positive, but it's not significant. So the feeling that we get is that, okay, here, as I said, there's less information asymmetry. I can talk directly to my friends and my family. I don't need to go through TripAdvisor. And this is a bit what we find, okay? So this is kind of our baseline regression. And all I'm going to show you now is kind of going further. So we do a huge amount of work to try to get rid of any concerns that you might have. Okay, so what are the 2 main concerns? So the first one, endogeneity. So for those of you who work in finance, well, this is everyone's darling. No matter where you try to publish, this is one that comes back and haunts you in your dreams. So what is the real effect in a sense? So are there omitted variables? What is causality, etc.? So here, the main endogeneity issue we might have is that, well, if you are a good restaurant, you might get a better rating and already a better access to that. So if I'm a very well-known restaurant, everybody knows me in the city, I might get huge TripAdvisor ratings of 4.5 or 5 or something. But the banker already knows this. So the banker doesn't actually need TripAdvisor. He already knows from other talks he has with customers, etc., that basically you are a good restaurant, you are in magazines, you are in newspapers, and they will just give you more data. Okay, so this is an issue we really face, to say that we don't know if it's because your restaurant, what is the link between the restaurant, the rating, and that capacity. Second problem that we face is manipulation. So again, as everyone knows, has been shown in many papers in the literature, that ratings are manipulated. That's not only true for restaurants, it's true for everyone. So there's a famous paper on Amazon as well on this. Manipulation just exists, okay? So what we are saying to start with is, okay, this is true. We know that people manipulate. We are not actually saying that this is false. But what we believe is that maybe the banker has more time. So if I'm, again, in front of a restaurant in the evening with my friends, I basically have more or less a minute to decide if I enter the restaurant or not. So basically, I need to get sure of the restaurant quality very quickly. If I'm a banker, I might take a week, 2 weeks, a month to decide what I'm going to do. And I have also more information. So I already have probably the balance sheet of the restaurant. I have some other information. So what we believe is that actually bankers might be less bankers might be less affected by this manipulation than a simple customer. Okay, I'll just put it like this in the room. You can agree or not. I really believe that bankers, with the time and the means they have, are maybe less inclined to take a wrong decision than a simple consumer in the evening in front of the restaurant. Okay, but this being said, we're still going to check if this is an issue or not. So let's go back to the first one. So how can we tackle endogeneity? So what we're going to do is actually use a regression discontinuity design. So what does this mean? So what it means is that we can exploit the rounding rule of TripAdvisor. Okay. So here, if I take a very simple example, let's imagine I have 2 restaurants. Okay. One restaurant has an average score of 374. The other one has an average score of 376. So you take all the ratings of one restaurant, you take the average, you get 374. You take all the ratings of the second restaurant, take the average, 376. So I think we can all agree that the difference is very small. So they shouldn't be different from that point of view. But the way TripAdvisor works is that the restaurant at 374 will be rounded down to 3.5, and the 376 one will be rounded up to 4. So basically this rounding thing actually is quite interesting for us from that point of view, because I have 2 restaurants that are intrinsically the same, but the way TripAdvisor works, it classifies them in 2 very different categories, 3.5 and 4. Okay, and this is basically what we are going to work with. So with this regression discontinuity design, what we are going to do is to say, okay, let's basically compare the restaurants that is just above the threshold to those just below the threshold. So let's compare all these 376, 377, 378 to those that are 374, 73, 72. So basically restaurants that are very similar in every respect, just while TripAdvisor randomly just puts them in 3.5 and 4. And we're going to do this for every single threshold. Okay. So if we do this, we can rerun our regression. So here it's the same as before, but with this idea to say, okay, is a restaurant just above the threshold versus just below the threshold different from that perspective? And yes. So what we find is that the coefficients are virtually the same. So here we go from 242 to 252. Here we actually change from, let me check, 172 to 167. And here it's a bit higher, but still insignificant. So even if we take into account the fact that this causality must be driven from TripAdvisor to that, it works perfectly well. Okay, so heterogeneity doesn't seem to be an issue in this case. Okay, and this is basically what we are then going to work with to say, okay, seems to be quite obvious, restaurants that are quite similar, and the only difference is the TripAdvisor rating still get more debt the higher the rating. Okay, then let's have a look at this another way. So another way to look at this is to say, okay, let's now concentrate on restaurants where basically there's a change in rating. So what happens to restaurants that go, for example, from 4 to 4.5 or from 3.5 to 4? So where we really have a rating change. So here what we do is, again, OLS regression with all the control variables, etc. And then we check, okay, if you go up on the rating, what's happening to your debt? If you go down, what's happening? So what we find is if you suddenly have a rating that improves, so let's say you go from 3.5 to 4, you suddenly actually also get more debt. And again, this is true for bank debt and not true for the family and friends. If you go down, so let's assume from 1 year to another, you go from an average rating of 4 to 3.5. Well, actually not a lot is happening. And this is a bit what we expect, because in the end, once the banker has given you the debt, well, he cannot ask for the money back. The money was given, tough luck for the banker, and that's it. So here we are not very surprised that not a lot comes out. What really is good for us is that this still works. So the better the rating, the more debt you are able to get. Okay. So another issue we might have is the timing of the rating. So what we have done so far is to say, we look at the data at the end of December, 31st of December. We look at the rating at the end of December, but this might not be reality. So you might have a restaurant that actually was not very well rated, let's say beginning of December or in June, and suddenly it improved quite considerably. Might happen, okay? So what we look at to resolve this issue is the following thing. So we kind of look at restaurants that were above a certain threshold 75% of the year. So if the majority of the year you have been actually, let's say 4 or 4.5 versus those that kind of go up and down, what's happening? So here what we see is that rating stability is very important, okay? So if you want to get more debt from a banker, your rating must be stable across time. So you cannot just try to very quickly manipulate a little bit at the end of the year and this is sufficient. No. The banker wants actually to see that you get regularly good ratings that are in line. So if you get ratings from 1 to 5 and then 2 and then 5 again, this doesn't seem good, doesn't seem to work. Okay. So this is, we look at the ratings stability over 3/4 of the year. We also look at this another way. So the other way we also look at this is what's happening if we now look at restaurants that have kind of the same rating for 6 months in a row. So again, a bit of stability. We get exactly the same results. So here, basically, those that have a high stability get more debt. Those that have a low stability get, well, not less debt, but they don't get more debt. Okay. Good. So last thing I'm going
Philip,
to just one slide, then question.
Yeah, sure.
Okay. So then another thing that we're doing is looking at placebo effects. So you could argue that the thresholds are should be random, but maybe they're not. So we look at kind of placebo thresholds that we create ourselves. So instead of having, I don't know, 275, 325, etc., we just take random thresholds. And what we find is that the effect disappears. So it's not the thresholds that drive this, well, it's the thresholds of TripAdvisor that drive this, and it's not just general thresholds that drive. Okay, sorry.
Yeah. So there's a question which basically says, do you find too much of a difference between the star ratings? As in, does the rating 3.5 to 4, does that make a significant difference? Or is it just the 5-star versus the others, which actually, the stars versus the others which create a difference?
So what we don't look at all the thresholds separately, but what we have done is actually looking at everything, so 1 to 5. And then what we have also looked at are only the restaurants, I would say 3.5, 4, 4.5. And 3.5, 4, 4.5 is basically 80% of the sample. So, so in both cases, we get exactly the same result. So if you look at all the ratings, or if you just look at the subsample of the ratings that occur the most, so we kick out the 5s, we kick out the 1 and 2s that are a bit weird probably, then we still get exactly the same result. That's it.
Yeah, I think so.
Perfect. So I just continue then and we'll see. Good. So next thing we can have a look at is manipulation. So we try to do several things. So the first one is try to focus on sample where we believe that manipulation is probably less likely. Then we also look at the distribution of ratings around thresholds. So if you believe that manipulation should happen, you would expect to see some behavior of different ratings. And then we also look at the determinants of crossing a threshold. So basically, if you have an incentive to manipulate because you're just below the threshold, and basically you just add another review and it kicks you up a notch, then you have an incentive to manipulate. So if you're, for example, just at 374, you add one review and you go up to 376, then you have a huge incentive to do something. Okay, so here we basically look at this. I haven't shown this, I'm not going to show this in the presentation because of time purposes. This doesn't seem to drive everything. So this idea to say people who have a huge incentive to manipulate are going to do this is not something that we find. So let me have show you the two other things. So what we do to start with, it's quite obvious, is to look at the number of reviews. So if you have 1 or 2 or 3 or 4 reviews, probably it's the friends and the family of the restaurant owner. This is not very reliable. If you have 300 reviews, manipulating is much more complex. So I know that nowadays you can do this large scale, but still I'm maybe a naive person or maybe just an optimist, I don't know. If you have 200, 300, 400, 1,000 reviews, I think manipulation is much more difficult. And what we find is that the link between that and ratings actually is very strong if you have a lot of reviews, and it kind of disappears if you have only very little reviews. Okay, so if you have 1, 2, 3, 5, 10 reviews, the link disappears. And again, this goes in direction to say the banker is not stupid. The banker has time to analyze this. And if he sees that the restaurant only has, like the one I showed you, 8 reviews, probably this is not good information. Okay, so goes into the direction that the banker actually does his job quite properly. Then we also look at the effect of inexperienced reviewers. So what we can do with the data that we have from TripAdvisor is actually look reviewer by reviewer how many times this guy has reviewed. And again, if I only review one restaurant in my life, it probably means that I know the owner and I'm just helping him out. If I review, I don't know, 30, 40, 50 restaurants that are very varied in different countries, probably I'm not a robot, and probably I'm somebody who just likes restaurants and honestly gives an opinion. Okay, and this is basically what we find. So if we look at those restaurants that have a lot of reviewers that are kind of one-off reviewers, the effect disappears. If we only look at restaurants that have a lot of experienced reviewers, the effect remains. Okay, so really to have a lot of reviews and qualitative reviews, this is really where things are happening. If you basically look at all these weird people who or restaurants that have one review and the review probably comes from a person who only has ever given a review, this doesn't work. Again, the banker is doing his or her job quite well. So seems that manipulation is not too much of an issue for our results. Second thing that we look at, as I said, is to look a little bit at distribution. So here we look at all the thresholds. So this would be the red bar. And then we look just below the threshold, how many reviews do you get? And then just above the threshold, how many reviews do you have? So if manipulation was really an issue, we would actually expect to have many reviews just above the threshold. Okay, so I know that, okay, I just need 1 or 2 positive reviews, and then I might go from 4 to 4.5. So I will incentivize people or do it myself. And here, what I would expect if this was the case is that I would have huge amount of reviews just here and many less over here. So people would really just go up. And what we find is that this is not the case. So it actually seems that there are more reviews just below the threshold than just above. So this looks like, graphically speaking, at least, that there are not too many people who kind of manipulate the reviews in a given restaurant. And then we also do something that is called the McCrary test that actually does this in an empirical way. And what we find is, again, that the density mass is not different below or above the threshold. Okay, so this again alleviates the manipulation concern. So we cannot really say that manipulation doesn't occur. I don't know, nobody knows, but we are quite convinced that it's not a huge issue in our case. Then what we also look at is for whom this kind of works. So having better reviews, where is this really interesting? And this goes back to this information asymmetry idea. So what we find is that the relation between that and TripAdvisor rating is actually the strongest for young restaurants. And young restaurants are basically those that haven't been around for a long time, where additional information probably is not very available. And this is really where the banker is interested in TripAdvisor. For restaurants that are very old, so this is basically a top quartile, so more than 19 years, or rather more than 18 years, well, the effect disappears because the banker probably already has given out a loan. The banker already knows the restaurant. It's been around for 20 or 30 years. You don't need TripAdvisor to get an idea. Second thing we look at is Michelin. So Michelin guide in France. So here the same story. If you are in other foodies and food guides, well, you probably don't need TripAdvisor as a banker. And this is exactly what we find. So if you are in the Michelin, if you have a Michelin star, the banker doesn't need TripAdvisor. If you don't have a Michelin star, then this is helpful for the banker. And then finally, we also look at the price range. And what we find is that the relation actually disappears for very expensive restaurants. So again, here probably these are the Michelin restaurants. Those are the restaurants that are very well known. On the other side, if I look at very cheap restaurants, so this might be street food and stuff like this, well, there basically there's more competition. It's much tougher to know if one pizzeria is better than another one. And there the TripAdvisor rating really is helpful. So it helps the banker to know if the pizzeria on corner X is better than the pizzeria on corner Y. And that's it. Okay. So here really it helps. So it's really important for restaurants that are young, that face a lot of competition and that are not really in other kind of guides or information sources. Okay. So what is the mechanism? So the mechanism is the following. So the first thing we had in mind was to say, okay, actually this is easy. So if you have good TripAdvisor ratings, this will impact your demand. So more people come to your restaurant, revenues goes up, the net income goes up, cash flows go up, and you get more debt. That was our initial idea. And actually, to our surprise, we don't find this. So if you look in the long run, so over 1, 2, 3 years, actually, we don't find a link between TripAdvisor ratings and sales or cash flows. So it doesn't seem that in the long run, good TripAdvisor ratings actually increase your sales or cash flows. It's a bit weird, to be honest. But the argument we have is that at one point in time, you have a restaurant, you have, I don't know, let's say 50 seats. It's very difficult to increase from 50 seats to 70. So once your restaurant is known and full, it's difficult to increase the size. So this is what we have in mind to say, well, this might be an effect for the sales and for the cash flows. Well, maybe you just spent some money and so your cash flows went down or stayed stable. However, what we find is that there is some short-term effect on demand. And what we mean by this is what you said at the very beginning, one of the questions that we had, is that you have this cluster effect. So if you have a good TripAdvisor rating, you kind of increase good TripAdvisor ratings through time, which shows that demand in the short run probably kind of increases. And this is also a little bit what Luca finds in his paper, is that there is a very short-term effect on sales, so over a month or so, or maybe 3 months, but not over 1 or 3 years, as we show. Okay, so that was a bit of a surprise, but it's an interesting result. So those people who believe that TripAdvisor and good TripAdvisor ratings are helping you to get higher sales, maybe, but on average, no. On average, it doesn't seem to work. So what's happening instead? So what's happening instead, as I said, is basically that cash flow volatility goes down. So if we look at the volatility of cash flow through time, the restaurants that have good TripAdvisor ratings have much more stable cash flows. And this is basically what the banker looks at. So the banker is not looking at this and saying, oh, great, you have high revenues. No, this is not the case. The banker looks at this and says, oh, I won't have bankruptcy issues with this person because the cash flows are very stable. It's much more easy to forecast. I know that they will not have cash flows going up and down. So I will trust them more and I will be more willing to give them money because they will be able to pay me back and pay the interest. So this is what the banker actually sees, which is, I think, quite important for the bank and quite important for the company as well. So we also look at this a second way. So the second thing we look at is this demand shock. So unfortunately, we don't have the data for the COVID period, but we have another shock. So what we had, unfortunately, in France, as also happened in India a few years ago, is terrorist attacks. So in 2015, we had huge terrorist attacks in Paris with hundreds of deaths. So here, some of the attacks were in theaters, and some of them were actually in bars and restaurants. So this was really a huge shock for bars and restaurants because nobody wanted to go to bars anymore, because they basically came and just shoot at people randomly, a bit like the hotel attacks in Mumbai. So this is what we are looking at. So we kind of do a different thing where we look at restaurants with good ratings versus bad ratings before and after the terrorist attacks. Okay? And what we find is actually going the same direction as before, is to say that the terrorist attacks had a very, very negative effect on sales and profitability. This is what we would expect. Nobody goes to the restaurant anymore. But we see kind of a moderating effect of the good TA rating. So when we interact the terrorist attacks with the TripAdvisor rating, we find that on average, again, if the rating is better, you are less impacted or less negatively impacted by these attacks. So again, seems that you're kind of more resilient to problems and to cash flow shocks. And I see there might be a question.
Yeah, there are a couple of them. So first is that what is the role of relationship banking in the results you observe?
Sorry, could you repeat that?
Yeah. What is the role of relationship banking? So I have a long-standing relationship with a particular bank, and that possibly influences the factor influencing my debt, and not the TripAdvisor ratings. So do you think that plays a role?
This is actually a question we get quite often, and we cannot resolve this. And we actually, in a sense, don't exactly know. So this is the bad point. So I can just give you my opinion if you want. So ideally, what we would love to have is what is the nearest bank branch, and then see, okay, if the bank branch is just opposite the restaurant, I agree. The banker doesn't need TripAdvisor. He just needs to open the eyes and sees every day how many customers go in and out. The issue is that in Paris, you have bank branches everywhere. So we have two issues. The first one is that we don't know with which bank the restaurant has the loan. We just know the debt and that's it. So we don't know if it's bank A, B, or C. And basically, we cannot even infer this. So we could actually collect, we started to do this, collect the addresses of the banks and see if it's close to the restaurant. The issue is then that you kind of have 4 different banks that are quite close. In maybe a perimeter of 300 meters, you have maybe 10 branches, sometimes even the same bank branch, same bank. So we have difficulties to look at this. But what we, again, would say is that, yes, probably if the banker knows the restaurant, the effect is probably less, is less there. I agree.
There was a suggestion along with the question, but I think it may be difficult to implement it for your scenario, as you just mentioned, that this problem could have been possibly resolved by looking at only fresh loans. But I don't think you have that identifier where you can identify fresh loans from other type of long-standing loans. Right?
Difficult. Very difficult. As I said, the problem is really the accounting data. We have what we have, and it's not a lot, unfortunately. So we would also love to have data on interest rates and interest coverage. This we cannot do. It's, yeah.
Okay, so there's a second question, which basically says, what fraction of these loans are secured? The reason being that the results be more reliable with unsecured loans, especially the argument with cash flow volatility.
We don't know this in the data. So I don't know. I have basically just the bank debt and that's it. So what we also did was contact 4 or 5 banks just randomly to see what they do and to see if they actually use TripAdvisor or not. And what they told us is that it's kind of complicated to really have kind of securities, because for many of them, actually, they don't own their walls. So basically, the building belongs to somebody. Real estate on the one side might be a bank, might be an insurance company, might be a private person. And the restaurant is actually just leasing or renting the space. And with that, all they could actually use is the tables and the chairs. But this for a bank is not interesting as a kind of, they might use this as a guarantee, but yeah. So I would say the majority is probably unsecured loans. Yeah. The vast majority. That's what they kind of told us.
There is one more question. That is it possible of a reverse causality, as in bank loans influence in the TripAdvisor rating in terms of capacity expansion and they're putting in more infrastructure rather than the other way around?
Yeah. So if somebody has a genius idea around this, I'll take it. So that's actually the issue that we face. It's that we cannot dissociate between the demand and supply story. So I agree. It could be that I just see that I will have more customer as a restaurant owner. I go to the bank and get more debt. But it could so this would be kind of the supply idea. Or the demand is just that the banker sees these numbers and say, oh, great, this seems to be a better restaurant. So I just give them the loan. And before that, I wouldn't have given them the loan. And the issue that we face is that we cannot dissociate this. So we have tried multiple ways. We've presented this quite a few times. It's an argument that comes back every time, but nobody is able to actually give us a solution to this. We cannot dissociate this. I agree with if we could kind of show that, well, basically you have one restaurant, then you build a second subsidiary and the third one, and you just build branches, a bit like McDonald's at the beginnings, then this would basically hint that, well, it's more a supply thing. You have a good idea and you go and you just kind of become bigger. But we cannot do this, unfortunately. Most of these restaurants, they have just one restaurant and that's it. So yeah, sorry, I cannot, unfortunately, find a good solution to this and a good answer.
Yeah.
Good. I'm soon finished. So, so the last thing we wanted to show is this mechanism is again looking also at the clientele effect. So what we show is that this is especially important if you have a lot of foreign clients. So if you are a French citizen, you live in France, you live in Paris, you probably know your restaurants, you know what you want to do and where you want to go, and that's it. So this kind of resilience to shocks and the more stable cash flows are very important for foreign clients. And this is basically what we show. So if you have a high proportion of foreign clients based on the language of the review or based on the location of the reviewers, this is basically where the resilience is a bit strong. Okay. So again, foreigners, like everyone, you don't know the cuisine, you don't know the region, you go for TripAdvisor, and this is where this stuff is happening. So last thing I wanted to show you is basically what they do with this extra money. So when you get extra debt, what do these restaurant owners do? So they could do different things. So the first thing would be that they basically just use this as cash and to bolster their liquidity. Not something that we find. So it doesn't seem that they just get debt in and just leave this on a bank account and that's it. Second thing they could do is pay dividends. So this has been shown for larger companies. So there are all these dividend series where you basically take debt to make your shareholders happy and to pay out dividends. This is not something we find here. So it's not that the restaurant owner basically goes to the bank to get money and pay himself a handsome dividend. This we don't find. We also don't find that they invest in intangible assets. So again, seems obvious if you have a restaurant, what's this really intangible? You can maybe invest a little bit in your brand, but apart from that, there's not a lot there. So basically where the money goes is two things. One is tangible assets, fixed assets in a sense, and CapEx. So they really reinvest the money and put it back in the economy. And again, this we believe is quite important as a policy implication that, okay, if you have good ratings, don't be afraid of ratings. If they are good, people are going to get more money, they're going to invest, and basically they are going to be better for the economy at large. So if we dig a bit deeper, so what exactly do they invest in? Basically, they invest in materials, tools, and other tangible assets. And again, this seems quite obvious in a sense. So you are in a very large city. I mean, compared to most Indian cities, it's small, but for Europe, it's very large. It's, I don't know, 7-8 million inhabitants. Land is scarce. As a restaurant owner, you cannot buy land. It's impossible. You could buy a building, but probably most restaurant owners don't have the capacity to buy a building. Buildings are tens of millions of euros. So where they put the money is really to improve the restaurant as such. So again, it's cutlery, it's the chairs, the tables, maybe a better coffee machine, maybe more a better cellar, stuff like this. So this is really where the money goes, to try to improve the experience, if you want, of the customers through time. Okay, and this is basically what I wanted to show you. So to summarize, what we find is basically that online ratings have a direct effect on that capacity, that it makes restaurants more resilient to demand shocks and make restaurants also have more stable cash flows. So it's really much more on the risk side than the sales side. And this basically increases the leverage. So leverage still remains low, as we have seen, it's 18%, but it increases leverage quite substantially for those that actually use it. And again, what we find is that they basically use this to realize growth opportunities through investments in materials. Okay, so that was it for me. So thanks a lot for attending. So don't forget to review us, maybe not on TripAdvisor, but if you happen to be my referee in a journal submission, be nice to us and rate us favorably. Okay, thanks a lot.
There's one more suggestion, not exactly a question, but is it possible that this better ratings actually result in better supplier credit rather than the bank credits? But that may not be in the scope of this particular paper, but is that a possibility?
It's actually possible. So what we look at is really long-term debt. It's really financing from the bank in France. The current assets, or current liabilities rather, yes, I agree. My intuition would be that it helps, because again, if the supplier has more information and the supplier sees that you're a good restaurant, they might be more inclined to give you supplies because they are sure to get their money. And that's it. I'm not sure it's as problematic, because in the end, as a supplier, you normally get your money after 30 days. So it's maybe a bit easier to forecast. It's not like a loan over 10 years. But I think there might also be a positive link, yes. I would, at least if I was a supplier, I would use that. Any other questions?
No, not at this point.
Okay. All right, just stop sharing so you can see me more or less.
I think Abhiman has joined also.
Yeah.
Abhiman is the chair of the Mishra Center.
Okay. Hello. Nice to meet you.
Hi. Well, good to meet you.
Nice to meet you as well.
Thank you very much for your nice presentation. I could not attend the full session, but last half, whatever I could see, it was quite interesting. And the question and answers, what was going on, it was very nice. Thank you very much.
Thank you very much for having me, and thanks for attending. I know you're all busy, so it's always nice that people take time to listen to somebody. So thanks a lot, everyone.
Anirban, if there is no other questions, then you can close the session.
Yeah, so thanks a lot, Jen, for this wonderful session and the interaction. Best wishes from our side for your paper.
Thank you very much again for having me. So please say thank you to Prashant as well. I'll send him an email as well. It was very nice to have a first time presenting at an Indian school. I hope to be able to do it in the future as well. So all the best for the center. Yeah, hope to see you.
Thank you.
Thank you, John Philip.
Welcome. Thanks.
So with this, we'll